On September 10, 2001, the U.S. Secretary of Defense stood at a podium and dropped a bombshell. We cannot track $2.3 trillion. The next day, the world stopped watching. But the missing money didn't stop multiplying. In 2004, the Federal Reserve flagged unexplained liquidity operations. In 2008, billions vanished inside derivatives no one could price. In 2020, trillions flooded the system, but no one could say where they landed. Today, the number isn't 2 or 5, it's $9 trillion. Not on the balance sheets, not in the vaults, not in the markets. So, where is it? You're about to enter a part of the financial system no one is supposed to see. A place where money exists but leaves no trace. And inside it lies the 9 trillion hole that could swallow us all. It began with a sentence, September 10, 2001. Standing in front of a cluster of flags at the Pentagon, Secretary Donald Rumsfeld addressed a press room with a calm voice. According to some estimates, we cannot track 2.3 trillion transactions. No panic, no alarms, just a number. One that exceeded the entire annual defense budget. Gone. The next morning, no one remembered. What followed was chaos, war, and silence. But behind that silence, a hole had already opened, and it was growing. In the years that followed, researchers and auditors tried to trace the missing billions. They found black budgets, off-book accounts, funds rerouted through third parties. But not clarity, only fog. Then came 2008. The world watched in slow motion as titans of finance collapsed. Lehman Brothers, Bear Stearns, AIG, all brought down by toxic assets nobody fully understood. But behind those headlines was a more disturbing pattern. Central banks injected trillions to prevent a systemic collapse. Stimulus packages, bailouts, liquidity injections, terms used like bandages. But where exactly did that money go? Some of it was used to buy time. Some of it patched up broken balance sheets. But a large part? It entered what experts began to call the financial black box, a place where numbers move, but accountability doesn't follow. By 2011, the Federal Reserve's balance sheet had ballooned from under $1 trillion to over $2.8 trillion, but few could explain the assets they now held. Collateralized debt, mortgage-backed securities, derivatives with valuations based on models, not markets. It was a ledger written in smoke. By 2015, the hole had a new name, shadow banking, a parallel system of lending, credit, and leverage operating without traditional oversight, run not by governments, but by hedge funds, private equity, and international institutions. These weren't banks, they didn't take deposits, but they moved money at a scale that dwarfed entire economies. And most of their activity? Unreported, unregulated, untraceable. In 2020, the global crisis hit and the hole widened. To prevent collapse, the Federal Reserve unleashed an avalanche, over $9 trillion in emergency funding, not through Congress, not through taxpayers, but through complex instruments, repo agreements, bond purchases, currency swaps. Money was printed not in ink, but in code. And it disappeared just as quickly as it appeared. Today, the number sits like a shadow over the global economy. $9 trillion, neither lost nor found. No one can say exactly where it is, because it's not gone, it's just unaccounted for. Vanished into derivatives, collateral chains, dark pools, and offshore vehicles. And this is only the beginning. Because once you understand how that money moves, you start to see the system for what it truly is. A machine that creates value out of nothing, and sometimes creates nothing out of value. Welcome to the whole. On the surface, the financial system appears clean, regulated, predictable. Banks have auditors, governments have oversight, markets have rules. But beneath that surface, there's a second layer. A world where money moves faster, risk multiplies quietly, and the rules don't quite apply. This is where the 9 trillion hole truly begins to take form. It's called shadow banking, and it might be the most powerful financial force you've never heard of. Unlike traditional banks, shadow banks don't take your deposits. They don't have branches. They don't offer checking accounts. They exist in the margins. Hedge funds, money market funds, structured investment vehicles, private equity firms. But here's the catch. They move money on a scale that dwarfs most central banks, and they do it with virtually no public visibility. Let's break the illusion. In 2007, just before the financial crisis, the shadow banking system in the US had grown to over $20 trillion in assets. That's more than the entire GDP of the United States at the time. And unlike commercial banks, these institutions weren't required to maintain reserves. They operated with extreme leverage, borrowing against assets that themselves were borrowed. A house of mirrors. They created financial products with exotic names: collateralized debt obligations, credit default swaps, synthetic derivatives. But in the end, most of them boiled down to the same thing: bets. Bets on bets on bets. And when the bets turned bad in 2008, the whole structure trembled. But instead of dismantling it, the system adapted. New regulations came for the visible players, the banks, the brokers. But the shadow banks, they slipped through the cracks. They restructured, rebranded, relocated. London, Zurich, Hong Kong, Cayman Islands, new havens for old games. And the public? They never saw a thing. Because these institutions operate off-book. That means they can create liabilities without recording them like traditional banks. They use what's called structured finance, deals so complex even regulators struggle to understand them. Imagine a loan that's packaged into a bond. That bond is sold to a fund. The fund borrows against it to buy another loan. Each step adds opacity. Each layer hides the last. By the time you reach the 4th transaction, the original asset is unrecognizable. But the risk? It's still there, multiplied, hidden, unstable. And it gets worse. These shadow entities often rely on short-term funding to finance long-term bets, a practice known as maturity transformation. If liquidity dries up even for a day, the entire chain can collapse. In March 2020, that nearly happened again. As markets panicked, liquidity disappeared overnight. Treasuries, the safest asset on earth, couldn't find buyers. Money markets froze. Repo markets buckled. The Federal Reserve intervened with unprecedented force, backstopping not just banks, but shadow banks, offering credit facilities to buyers that technically weren't even under its jurisdiction. That wasn't just a bailout. It was a silent admission. The off-book system is no longer parallel. It's central. And that's the danger. Because while these entities are invisible on balance sheets, their failures are very real. They ripple outward through pension funds, through insurance portfolios, through sovereign bonds, all the way to your retirement account, your mortgage rate, your paycheck. The 9 trillion hole isn't just in the numbers, it's in the architecture. A structure designed to function in shadows until one day it doesn't. Most people think of the Federal Reserve as a kind of referee. But what if the referee was also playing the game? Behind every rate hike, every press conference, every carefully worded statement, there's a machinery that most people will never see. A system designed not for transparency, but for control. And at the center of that system lies a paradox. The Federal Reserve creates money, but it doesn't always leave a trail. Let's start with something simple, or at least it sounds simple: open market operations. This is how the Fed injects money into the economy. It buys securities, usually treasury bonds, from commercial banks. In return, it credits those banks with reserves, electronic money. Seems harmless, but there's a detail most miss. These reserves are not part of your paycheck. They don't build bridges, pay teachers, or fund hospitals. They stay inside the system, circulating, compounding, inflating asset prices, while the real economy watches from the outside. Then there are repos, short for repurchase agreements. The Fed lends money to banks, hedge funds, and financial entities overnight in exchange for collateral. The next day, the trade is reversed. But what happens when that overnight lending stretches for weeks, months, years? In 2019, long before the global crisis, the repo market quietly broke. Suddenly, banks were unwilling to lend to each other, a silent panic. The Fed stepped in, offering tens of billions in liquidity per day. No headline, no panic, just a quiet flood of money behind the curtain. And then came 2020. To contain the fallout, the Federal Reserve launched programs so vast, even insiders struggled to keep track. Corporate bond purchases, ETF backstops, foreign currency swap lines. Over $9 trillion in interventions, much of it through entities like the SPVs, special purpose vehicles. What's a special purpose vehicle? It's a legal entity designed to isolate risk. It allows the Fed to lend, invest, or absorb toxic assets without technically putting them on its own balance sheet. In plain terms, they created shell companies to do what they legally couldn't. A loophole wrapped in legalese, buried in footnotes. But here's the twist. It's not just money going out. It's assets coming in. The Fed now holds trillions in securities, including mortgage bonds and corporate debt, assets they would have never touched before. This changes everything, because when a central bank becomes the largest holder of debt, it's no longer a regulator. It's a market participant, a giant invisible player. And that player doesn't answer to voters. It answers to itself. Transparency? Only partial. Oversight? Filtered through layers of bureaucracy. Ask how much of that $9 trillion is still circulating, and you'll find vague answers. Ask what the collateral is, and you'll find redacted documents. Ask who benefits most, and you'll hit a wall. This is the fog, a financial climate engineered to appear under control, even as the mechanics rot beneath the surface. A system where the lines between lender, investor, and insurer blur, where accountability evaporates in acronyms and technical language, where trillions move without a vote, without a headline, and often without a trace. This isn't just about money, it's about power. And the deeper you look, the more you realize. The whole isn't just hidden by the system, it's protected by it. If you want to find the $9 trillion hole, you have to follow the assets, or rather, the ones that used to be assets. Because in today's markets, value is a performance, not a property. Let's start with a simple question. What makes something worth $1 trillion? A company? A government bond? A bundle of mortgages? The answer should be fundamentals, cash flows, creditworthiness, collateral. But what if the foundation itself is fiction? In the run-up to 2008, trillions of dollars were pumped into mortgage-backed securities. Packages of home loans, sliced, rated AA, and sold around the world. Everyone believed they were solid, until they weren't. When defaults began, the entire market seized. Institutions realized they were holding paper with no price, no buyer, no liquidity, no value. This wasn't just a crash. It was a revelation. Assets can vanish. Since then, the system has become smarter, but not safer. It learned how to hide risk, not eliminate it. Let's look at derivatives. Estimates put the total notional value of global derivatives at over 600 trillion. Most of them are unregulated, traded over the counter. No centralized clearinghouse, no unified ledger. They're contracts between parties, bets on interest rates, currencies, defaults. If everyone plays nice, the system hums. But if one major counterparty fails, the ripple could be catastrophic. And many of these contracts are backed by collateral, assets pledged to guarantee the deal. But here's the twist. That same collateral is often reused in multiple transactions, a practice called rehypothecation. One bond becomes the security for 10 different loans. If one link breaks, the whole chain collapses. Now imagine trillions in these chains, scattered across institutions, some offshore, many unreported. The value exists until it doesn't. Then there are zombie assets, companies that no longer generate profit, propped up by cheap debt and low interest rates. Their bonds are still held in retirement funds, ETFs, even central bank portfolios. But they're dead weight, liabilities dressed as investments. In China, entire cities stand empty. Real estate developers like Evergrande defaulted on hundreds of billions. But much of that debt was held internationally, securitized, sold, and resold. Where's the asset now? On someone's balance sheet, marked as performing, but in reality, worthless. Even gold, the so-called safe haven, isn't immune. Some financial institutions sell paper claims on gold that exceed the actual physical supply, a system of fractional gold reserves where the promise is worth more than the metal. It's all built on confidence. As long as no one panics, the illusion holds. But confidence is fragile. Ask Archegos Capital, the $20 billion family office that imploded in 2021. Its collapse triggered 100 billion losses across prime brokers. Why? Because its value was based on synthetic exposure, derivatives tied to borrowed stocks. When prices turned, the house crumbled in hours, and no regulator saw it coming. So what does this mean for the $9 trillion? It means part of that number is made of ghosts, instruments that only exist on screens, assets that no longer hold value but still hold space. On a spreadsheet, they look like wealth. In reality, they're placeholders for losses not yet acknowledged. And here's the worst part. Institutions are incentivized to keep them marked as real, because admitting the truth would trigger a chain reaction. The whole isn't just money, it's made of denial. And denial is what keeps the system upright for now. Every system built on illusion has a countdown. Not a digital clock, not a calendar date, but a threshold, a point beyond which the lie can't hold. And for the global financial system, that point is getting closer. The 9 trillion hole isn't just a missing number, it's a structural flaw, a pressure chamber of unseen debt, synthetic value, and quiet leverage. The fuse is already lit. The question is, how long until it reaches the core? Let's talk about liquidity. In March 2023, U.S. regional banks began to fail, not because of criminal fraud, but because of duration mismatch. They were holding long-term bonds while depositors wanted cash. As rates rose, those safe assets became unsellable without massive losses. Sound familiar? That's the same mechanism lurking inside the global collateral system. If enough counterparties demand real liquidity, real dollars, real assets, the game ends. Why? Because the entire system is built on confidence in substitution. A bond can be used as collateral until someone questions its value. A repo agreement can roll over endlessly until someone demands repayment. A derivative can hedge risk until it multiplies it. Every one of those steps relies on trust, and trust can disappear in a day. Now imagine this. Central banks are forced to raise interest rates to fight inflation. That sounds like discipline, but in practice, it's a time bomb. Higher rates crush zombie companies, destabilize bond portfolios, and trigger losses in everything from commercial real estate to sovereign debt. And when institutions suffer hidden losses, they stop lending. Credit freezes. Markets panic. And the only solution becomes more liquidity, more printed money, more off-book programs, more complexity. The hole gets deeper. And at some point, no one knows exactly when, something breaks. A major fund collapses. A clearinghouse fails to settle trades. A sovereign defaults, and the ripple hits the derivatives market. Then the countdown becomes visible. Screens turn red. Phones stop ringing. Central banks gather in silence. But here's the twist. This time, the tools may not work because the system is already saturated. Interest rates can't be cut forever. Balance sheets are already bloated. Political tolerance is thinning, and the hole is too big to fill without tearing something else apart. So what happens then? Pensions lose value. Currency confidence wavers. Nations begin to decouple, financially, geopolitically, digitally. We enter a phase not of collapse, but of fragmentation, where trust becomes localized and value becomes tribal. Some will flee to gold, others to Bitcoin. Some will cling to real estate, art, or even food supplies. Because the dollar isn't just a currency, it's a promise. And if enough people stop believing in the promise, the system unravels. The 9 trillion hole becomes visible, not as a single event, but as 1,000 small detonations, bank by bank, fund by country. And when it's done, the world will still be here, but the game will be different. The question is, will you see it coming? Or will you realize, too late, that the countdown had already reached zero? There's a room somewhere. No windows, no clocks, no cameras. Inside, a handful of people know exactly where the money went, what it became, and what it cost. But you weren't meant to find that room. You were meant to believe the illusion. That debt is just a number. That markets always recover. That someone, somewhere, is in control. But now, you've seen the hole. You've traced its edges, felt its gravity. And once you see it, you can't unsee it. So if this opened your eyes, if you want to go deeper, if you're ready to question what they built, like this video, subscribe, and stay close, because this isn't the last hole we'll uncover. Not even close.